Okay, let's just cut right through the noise. In this explainer, we're unpacking the investment thesis for Grasim. As institutional investors, it's honestly super easy to get distracted by short-term variance. But today we're zooming out. We really need to look past the immediate quarter's bottom line noise and clearly see the massive scale-up phase that's actively driving this diversified conglomerate right now. We'll be looking directly at the underlying data from Mirai Asset Sharehan's latest Q4 results update to see exactly what's powering their growth.
So, here's our roadmap. We'll start with the executive summary, dive into building materials, break down chemicals and core segments, map out strategic capital allocation, and then finish up with the long-term outlook and risks. Let's get right into it.
All right, Section 1, the executive summary.
So the crucial point right off the bat is that Mirai Asset Sharekhan has decisively retained a buy rating on this 2.14 trillion rupee market cap giant. I mean, they aren't just holding steady here. They've actually revised their sum of the parts price target upward to 3,530. That is a massive vote of confidence in the underlying fundamentals, especially when you consider the sheer scale we're dealing with.
This quote, pulled directly from their call, perfectly encapsulates the thesis. Grasim's standalone revenue didn't just meet expectations, it strongly beat them by 12.6%. We're looking at a top line that hit 11,774 crore rupees, and that's driven by a massive 31.9% year-over-year surge, mostly fueled by incredibly strong traction in their paints and B2B e-commerce ventures. The growth engine is literally firing on all cylinders.
Now notice the totally fascinating dichotomy in these Q4 results. Operating profit surged an astonishing 145% year-over-year to 541 crore rupees, with EBITDA margins expanding by 212 basis points. But wait, if you look at the reported profit after tax, or PAT, you actually see a loss. Why is that? Well, it's because that net profit number is being heavily, and I mean intentionally, impacted by initial strategic investments in new, aggressive businesses like Birla Opus and Birla Pivot. It's basically a calculated short-term squeeze for long-term market dominance.
Moving on to Section 2, Building Materials Scaling Up.
Let's dive into our first major growth engine, the Building Materials division, which actually just reported its highest ever quarterly revenue. Birla Opus isn't just growing, it's absolutely exploding. They're already the number 3 player in organized decorative paints. Their capacity is a staggering 1,332 million liters per annum. To put that into perspective, that is 24% of the entire industry's capacity. They doubled their FY26 revenue versus FY25, crossing a 10% market share. And while management has flagged significant raw material inflation, Birla Opus is actively offsetting this with strategic price hikes. That proves their serious pricing power across a vast network of over 11,500 towns.
And this next part clearly illustrates the foundation of the segment. While Opus is the aggressive new growth frontier, Ultratech Cement provides the massive underlying strength. They crossed the 200 million tons per annum capacity mark in April 2026, and they are aggressively targeting 240 plus by March 2028. With an operating EBITDA per ton reaching 1,253 rupees, Ultratech is really the cash-generating bedrock that makes the rest of this entire expansion possible.
All right, Section 3, Chemicals and Core Segments.
So while building materials definitely get all the headlines, the core businesses are out there doing the heavy lifting. Breaking this down, these foundational businesses remain incredibly solid cash generators. Cellulosic fibers brought in 4,614 crore, growing at 14% year-over-year. The chemicals division contributed 2,458 crore, marking a solid 7% growth. These aren't just legacy placeholders, right? They're actively growing revenue streams that provide crucial stability to the whole conglomerate.
Let's look at the why behind those numbers. First, in cellulosic fibers, the business EBITDA actually doubled to 588 crore rupees. That was driven by pure volume growth, sharp operating efficiencies, and a really favorable product mix, which was also aided by benign pulp prices. On the flip side, looking over at chemicals, they saw a 3% EBITDA bump to 304 crore. Because they're the undisputed market leader in chlor-alkali with 1.5 million tons per annum capacity, they were able to leverage better profitability in caustic and chlorine derivatives. That effectively helped them navigate higher input prices over in specialty chemicals.
Which brings us to Section 4, Strategic Capital Allocation.
Understanding how Grasim actually funds this massive multi-front expansion requires us to look really closely at their capital allocation flywheel.
This cash flow ecosystem is what actively de-risks the overall portfolio. Just look at this flow. Grasim expects an inflow of nearly 4,000 crore rupees from Ultratech's dividend alone. So what do they do with it? Well, part of it goes to reward Grasim shareholders directly. But strategically, they're taking 2,880 crore and pumping it right back into Aditya Birla Capital's preferential allotment. This move maintains their 52.3% stake and gives them a massively scaled, diversified proxy to ride India's overall financial ecosystem growth.
So, the absolutely crucial point here is that internal revenue and EBITDA are intentionally being reinvested right back into these aggressive growth businesses. Management has explicitly clarified this. The standalone bottom-line pressure we discussed earlier, it's not a sign of operational weakness. Actually, scratch that. It's the exact opposite. It's a highly calculated capital allocation strategy to scale Birla Opus and their B2B platform Birla Pivot to completely dominate future market share.
And finally, Section 5. Long-term outlook and risks.
Let's project forward. Now, obviously, we absolutely must acknowledge the risks, things like group company funding requirements and any potential weakness in the standalone business. However, the valuation trajectory estimated by Sharekhan is honestly staggering. Revenue is projected to climb from roughly 41,000 crore in FY26 to nearly 54,000 crore by FY28. But more importantly, as this initial investment phase matures and that operating leverage really kicks in, adjusted profit after tax is projected to nearly triple, going from 478 crore to 1,350 crore in that exact same window.
Which brings us to the ultimate question for your portfolio. With Ultratech throwing off massive cash to fund the flywheel, the core chemical and fiber segments operating with incredible efficiency, and Birla Opus aggressively capturing major market share in the paints industry, you really have to ask yourself, is the broader market truly pricing in a growth engine of this scale? Looking at the data, it sure seems like this giant is just getting started.